how did you first do your due diligence for the sponsor or the operator that you work with? Because it was a new process for you. What made you decide that this is a team that I wanted to go with?
That's a very good question. So for me, I first joined a multifamily mentorship group so I could learn and so that I could be around other people that have done it. And then I started to ask other people, who have you invested with? What's been your experience? And I started getting recommendations from people. You really should talk to these people. And then I got on a bunch of different people's email list, and then I started to get emails with different, deal opportunities. And then my first deal, I invested with somebody that a lot of people had given me positive recommendations for.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba, a commercial real estate investor. And today I have a very good friend, Darin Batchelder, with me. Welcome to the Real Estate Vibe Show, Darrin.
Vinki, thank you for having me. I'm excited. This is going to be fun.
Exactly. A little bit about Darrin. Darrin is a seasoned multifamily syndicator, successful podcast host, published author, and a savvy investor with extensive experience in managing over 9,000 multifamily units. He's also a dynamic business owner with a proven track record of success. And today we're going to be discussing that topic, multifamily investing. So before we get started, Darrin, would you please briefly share your background with me? How did you get involved in real estate investments?
Sure. So I'm 53 now. I only got involved probably 5 years ago. I was 47, 48. And my past, I started out as a CPA, then I was in software sales, and then I was trading large portfolios of loans for a large Dutch bank called ABN AMRO, and which was focused on residential, multifamily, and commercial real estate loans. Actually, they were only multifamily and residential. And that was like 2002 to 2006, 2007. I started my own company doing that, and I still have that company. And, over the years, I had so many bank presidents and chief lending officers tell me that they just love the performance of multifamily loans in good times and in bad times. And shame on me. It took me a long time before I decided, you know what, they might have something here. So finally I got involved and said, you know what, I've been hearing this for years. I'm actually going to go out and start buying some real estate. And I started with a duplex, and then I just grew from there. And now, I'm invested in over 9,000 units and as an LP, and then as a GP, 14 properties. So it's been a great run, and I've learned a ton, and the returns have been fantastic.
Great. So let's talk about a little bit about the lingo over here. A lot of people use this terminology, LPs and GPs.
Yeah.
What was your first impression about LPs and GPs? What was your understanding, and how did you get the deeper understanding of the meaning of it? And you decided, okay, I want it to be just LP.
Yeah. So LP stands for limited partner, GP stands for general partner. And after I bought the duplex, my wife and I, I was like, we're going to make money on it, but it's just going to take forever to really build any significant wealth. So I went looking for a way to go bigger. And, at first I went to different real estate seminars and local RIA groups, and they were mainly focused on fix and flip single family homes. And I knew I didn't want to do that. I wanted to do larger deals. And so I finally came across a group that was focused just on multifamily. And I met some people there, and I just happened to meet a nice couple that said that they, were in the same boat. They really didn't understand the industry, but they wanted to get something that was scalable. And then they started sharing with me their returns, and it was unbelievable. So at that point, I was like, all right, I'm going to give this a chance. And I'm first going to invest in other people's deals. And that's what being a limited partner is. You're taking some of your money and you're investing in a deal with somebody else who they're going to manage the deal. And so I took money out of the stock market, and then I started to invest with other syndicators. And I knew I wanted to be a lead syndicator at some point. So I kind of spread my capital around to different syndicators because I wanted to learn, how do they manage the deal? How do they communicate with their investors? What's the process, so that I could form my own opinion on how I want to do it when I get started.
So let me ask you this question now here. How did you first do your due diligence for the sponsor or the operator that you work with? Because it was a new process for you. What made you decide that this is a team that I wanted to go with?
That's a very good question. So for me, I first joined a multifamily mentorship group so I could learn and so that I could be around other people that have done it. And then I started to ask other people, who have you invested with? What's been your experience? And I started getting recommendations from people. You really should talk to these people. And then I got on a bunch of different people's email list, and then I started to get emails with different, deal opportunities. And then my first deal, I invested with somebody that a lot of people had given me positive recommendations for.
So what would you recommend to a aspiring investor, how or what they should do?
Yeah. So,
take the first step?
A lot of people talk about limited partners. Okay, if you're going to get into your first deal, what should you do? And a lot of people will answer, pick a syndicator that like, and trust. Pick, somebody. I particularly have one step before that. I say pick the market first. So, I'm invested in growth markets. So like Arizona, Texas, the Carolinas, Georgia. I'm not invested in Florida, but I would invest in Florida. So first is the markets. And then once you know what markets you want to be in, then find syndicators that do deals in those markets and get on their email list. Then once you're on their email list, when they have a deal, they're going to send you the deal. And most of the time they're going to have a webinar. So you can sign up for the webinar, and you don't have to invest, but it's a learning process. So you listen to the webinar, you watch the webinar, you hear questions that other investors ask, and then you learn from that. I would highly recommend getting involved in a multifamily mentorship group if you have the capital to do so. If you don't, I would recommend that you go to multifamily meetups, the free meetup groups. So you meet other people that have done it, and then you ask them, who have you invested with?
You mentioned first research the market. That's a very good tip right there. But as a newbie, a lot of times people don't know about the markets. They just wanted to maybe invest in their own backyard,
right?
Where they are, and they do not know much about the market. So can you share some of the tips or tools that work for you on the market research side?
One, why do I pick growth markets? And what are some of the other aspects that I look at for markets? One is it landlord friendly, right? So the states that I'm investing in, if there's a tenant that is in the property and they're not paying their rent, it's landlord friendly, the state. So you're able to get the tenant evicted if they're not paying the rent. Where there's some states that are more tenant friendly, and they may stay in the unit for 6 months or 9 months, or I've heard people have horror stories where they're in for 12 months and they're not paying their rent. Well, that really impacts the performance of the investment. So I want to be in landlord friendly states. I want to be in states that have growth of population and growth of income and growth of jobs. Why is that important? That's important because if a tenant leaves, you want to know that there's people that are wanting to come in and fill that spot. If you're in a market, say you're in a market that is losing population, okay, but you're like, well, I want to be in my backyard. Well, if a tenant leaves, you may not find another tenant for a while. And then you have nobody paying rent in that unit. In these, what I found in these growth states, there are just a ton of people moving in, and that provides competition for those units.
So what was your first hesitation to invest in multifamily? Did you have any hiccups there? Because a lot of times, investors, they get into analysis paralysis and they're just sitting on the sidelines all the time. And then you might have heard this multiple times from multiple people. Oh, I wish I should have started 10 years ago. I wish I should have done this, could have done this, all those things. So what would you recommend, or what would you share from your experience with my audience? How can they break those limitations and jump on the board?
It's a great question. I believe that you have to decide that you're actually going to invest. You have to make that decision. It has to be a conscious decision. Then you have to believe. You have to believe that you could actually do it, right? Whether it's doing it passively or doing it actively. If you don't believe it, then you're most likely going to back out. What I've found is almost every deal that I've invested in, there are something that I don't like. There's a lot of things I like, but there's risk. In every investment, there's risk. And so, when I decided to do it, I just decided to push past the fear and invest. And then I saw positive returns, and that gave me more confidence to do it again and again and again.
Can you talk about some of the risks too, and how somebody can gauge their risk appetite?
Yeah. So, most deals, it's funny because I get a lot of deals coming through my desk. You probably do too, right? And the return profile on most of the deals looks similar, right? It's going to be somewhere between 5 and 8% cash on cash, and somewhere between an 80% return and 120%. So a 2x multiple, and so people say like, well, how do I pick the right deal, right? And then all of a sudden somebody has an outlier and they say it's a 3.5x. Wow, this one looks really good, right? But you can manipulate the spreadsheet to kind of say what you want. So that's where it goes back to, and everybody has a different way of looking at it, but I look at the market and then I look at the people. And if the people have a strong track record of providing strong results, then I look at the deal third. I look to see, is there anything that sticks out to me as a red flag? If it doesn't, then I'm trusting in that syndicator, because it's a big reputation business, as you know.
Yeah, I agree on that. You said it very well, because this is all about you're betting on the jockey versus the horse.
Right.
If the jockey is good, the operator is good, they're going to turn the bad deal. And if the operator is not good, they're going to turn the good deal into a bad deal too, regardless of the market, regardless of the location, regardless of the property type, Right. It all depends upon the operator and the business plan, because that's very important. And then everybody should pay attention to that, like what kind of assumptions they have. And then what is the track record? How did they completed their business plan in the past deals? Were they ahead of schedule, or they were on schedule? What was missed? Because all those things are important when you're looking into any deal. I really agree with you on that. So here I'm going to ask you this question. Can you tell me about a time when you face a major challenge in one of your deals that you invested in? And how did you mitigate that challenge, or how did you communicate with the operator?
Yeah. Good question. So I get talked to two. One being as an LP, and one being as a general partner. So one as an LP, I've had, because you have a podcast, I'm sure you get asked this all the time. I get asked this all the time, like, who are the good operators and who are the bad ones? And I don't throw anybody under the bus. I'm like, you got to do your own due diligence. And when I remember when I first was asked that question, I was in a number of deals as an LP, and I saw the syndicator in my head. It was my dog deal. It just, we bought it. It was like 80 something percent, 85% occupied. And then it dropped into the 70s. And I'm like, oh no, this is going to be trouble. And so I purposely did not, say the person's name. And then about a year later, all of a sudden I saw deals that were trading around that property. And I'm like, holy cow, those are trading at fantastic levels. Our property now is back in the 80s and now into the 90s. That's probably going to be one of my better deals.
Mm-hmm.
And it's kind of like the newspaper article, like, once it comes out and, badmouth somebody, even if they write another article a week later, it doesn't matter. The damage is done, right? So what I've learned is some of these deals don't go in a straight line up. Some of them, they're great right from the get-go. Some of them have some challenges, and those challenges have to be worked out. And thankfully, I was invested with some people that I, know, like, and trust, and they did a great job turning it around. So that's one scenario as an LP. I did not, let anybody else know that I was, worried. I did not reach out to the operator. It probably, had I done it again, I would advise to reach out to the operator. Say, hey, what's going on? I just want to understand what you guys are doing about it. Like, that's the important part. There's going to be challenges, and you want to be communicated what those challenges are, but you also want the leader to tell you what action they're taking to try to, change course. So that's the one. On the GP side, I got involved in a deal that just was undercapitalized, and I didn't realize it. At first, the rehabs just took a lot longer and were a lot costlier. And so, and that's the deal I'm still in, and that's still a challenging deal. But I see the light at the end of the tunnel. But it's that's where you learn, I guess, is those difficult ones.
Exactly. And then I agree with you on that, because each deal has a timeline, 3 to 5 years to 7 years, and on those 3 to 5 years, 7 years, it could be a roller coaster ride. Anything can happen. But as long as the deal is back up on track by the time you're ready to exit and you're meeting your projections, it has to be good. But I don't think we should be getting heart attack in the middle of the deal. Anything.
Not only a heart attack, like, I see people like, post bad stuff on social media about their syndicate. Like, look, I'm a LP and a GP, and I know, like, I don't know any GPs that aren't like hustling, trying to make their deal, the best it can be. So, the LP just putting a post on Facebook, I think is, I don't know, I'm not really in agreement with that. Like, you have a problem, call the syndicator and have a conversation with them,
That's true. As long as the communication is clear and crisp.
Correct.
And then you're on board, like what exactly is happening with the deal, you should be okay with that, because you are well versed of the risk once you started investing in the deal. Or that's the reason we say we should do our due diligence, whosoever you're trying to invest with. And then on the operator side or the sponsors, they should be clear on their communications too. They should be appraising all the LPs, day one, telling them exactly what's happening in each and every deal. Nothing just by surprise, okay? This thing went wrong. All of a sudden, last month it was okay. So, which is not acceptable.
Yeah.
Those are, because that's what it shows, that the team is working good or not working good. And then it's never going to be a straight line or upward line. Okay, I invested now, so it's just going to be upward trend all the time. But by the end, if the projections are met, that's the best way to look at it, anybody's track record or the deal itself.
Yeah. Somebody said this about real estate recently to me. They said, with real estate, it doesn't really matter what the valuation is in the middle. As long as you keep making the mortgage payment and you hold on, really what just matters is what did you buy it at and what do you sell it at 5 years later? In the middle, it doesn't matter as much. Where with stocks, it's really hard because you look at your portfolio on your phone and you could see it's 50% down, and you're like, oh, now it has to go up 100% just to break even.
That's true. But the thing is, and the stock market, if you're investing like that, you're always going to be, most of the time, you're going to lose it. Not, I shouldn't say all the time, most of the time, because the thing is, here your money is locked in. So even the property went downhill a little bit, for the time being, and you feel like, oh, hi, you have more vacancy and you're not seeing as much cash flow that you're saying, a few months before. Still, you're not able to liquidate it because you're going to ride it all the way and you might be winner at the end. Not like stock market, like it's so volatile. You just buy the stock always at the high and then you sell it always at the low because it's all the emotional, irrational decisions right there. And it happens, I'm not even joking because people sit on the sideline, they wait for the stock. Oh, I'm not going to buy. It's going down, down, down. Sometimes you say, let me see if it has an upward trend. And they buy it high and then it could go down again.
Right.
Or sometimes people buy at low when stock is going down. And then I know this bank that just went belly up just recently. And I know one of my friends, he invested in that. He thought, the stock was $100 some and it was like 10 or 20 bucks or 30 bucks. Like, oh, this is a good time to buy. And he put so much money. So now what happened?
It's gone.
It's gone. Somebody else took over. I don't want to name any other banks.
Right.
But anyways, let me ask you another question.
Sure.
What are some of the common mistakes that new multifamily investors make, and how can they avoid that? Since we're talking about, from the LP perspective mostly today.
So mistakes that the LPs make or mistakes that the GPs make? Yeah,
the multifamily investors, the new investors, what kind of mistakes that they make?
Yeah. So, I've interviewed a lot of people, and one of the things that rings true for me is that, some deals have had challenges. I know I've asked people that have been in 50 different deals and have you ever lost money? Right. And 50 some odd deals, this guy tells me never lost money. So that tells me that it kind of marries up with what the presidents and chief lending officers were telling me all those years, that, for capital preservation, it's really a strong asset, but I did have one person that, actually I've had two, and they were both doctors that had deals that went bad. One of them didn't do any due diligence on the actual sponsor, and it ended up being fraud. So the sponsor was actually raising money for property that they didn't even have under contract.
Whoa.
So yeah, that's horrible. So you have to do due diligence on the person that you're investing with. The second person, the way he explains it is that he looked at some shiny pictures and he thought the property looked nice and he didn't know how to evaluate it. And he invested and he lost his capital. So both those scenarios were, getting to know the people that you're investing with. That's very, very important.
Yeah, you said it very well. It's very important to build a relationship first before investing. Do not invest with somebody day one. Do your due diligence, no matter how good it looks, develop a relationship before doing any kind of investments. So how do you build or maintain relationship with the partners, investors, or even different stakeholders in the deal?
So with the investors, it's typically so different. If you haven't invested in one of these deals, what's different with these syndication deals versus, say, investing in the stock market, you buy stock in Amazon and then you just kind of, wait and you just hope that the price goes up. With syndications, you're going to get an email from the lead syndicator on a monthly basis that is going to, outline, what's going on with the property, and then also attach financials. So not only are they going to be telling you, but you're actually going to be able to see the growth. So you're going to be able to see the collections of the property. You're going to be able to see the expenses. And that's partly how you learn too, is being able to, so you invest in a deal, you see their communication, and then it's kind of, the business just makes sense. You're collecting rent, and then you're paying, property taxes, insurance, and utilities, and then you have net income, and then you pay the mortgage, right? I mean, so it's pretty basic in terms of the P&L, but you get to see that as an LP on a monthly basis.
Yeah, it tells you the story, right? What exactly what the incoming is, money is, and what are the expenses are, what is the leftover, what it's going to look like. So it's kind of educational if you pay attention to it. So let me ask you this question over here. Can you share with me what was your first raise like? That's the question I wanted to ask, because since you're
first capital raise.
Yes.
So the first capital raise was on a deal where I was the lead syndicator. I partnered with a gentleman by the name of Raj Gupta out of Chicago, a really good guy. So he was the experienced guy. It was my first syndication. And I think we raised like $2.5 million. And, the difference between the new guy, myself at that time, and the experienced guy was he was like calm, cool, and collected in terms of the capital raise. And I was, like, what if we don't get it? And what I realized was there's a lot of people out there that are looking to put money into good investments. And if you learn to, that it's not personal, it's not personal. Some people have a different use for their money. Some people have different ways of looking at money. Some people want to invest in real estate. Some people want to start a business. Another thing I learned was, don't make the decision for, your network. So what I mean by that is there were certain people that I was like, oh, this person is wealthy, no brainer, he's going to invest. And then another person, I'm like, oh no, there's no way this person's going to invest. And I was surprised. Like the wealthy person was like, hey, Darrin, man, I just put capital into this other business. I don't have the capital right now. The other guy is like, hey, how does this multifamily thing work? Can we meet for coffee and talk about it? And then he invested. Like, had I not given him the opportunity, I never would have known that.
That's true.
So, I would say it's an opportunity for everybody. And, if they decide not to pursue that opportunity, there's no personal feelings, just move on to the next person. But there's another person that is sitting in cash and wants to have a better return. And when you get to that person, then they're like, thank you for calling.
That's true. I agree on that. I mean, there's so many people out there, so you shouldn't hang on to one person anyways, But the other question I wanted to ask you here is, you have a podcast too, very famous one. So how do you leverage your podcast to reach out to the new investors or educate your existing investors in your database, or how to reconnect with them? So if you can share any tips and tricks there with us.
Sure. So when I started the podcast, I really wasn't sure what the ROI would be, and I have received, passive investors that have reached out to me, from listening to the podcast. But the podcast, when I look back on it now, is really one, I've learned a ton, and because I've talked to a lot of other people that are in the business and I've asked a lot of questions. So I've learned so much. Secondly, a lot of the guests that I've brought on are syndicators, and they actually were like, hey, Darrin, let's partner on a deal together. So I would say that the bigger return has been partnering on deals with other people that have come on the podcast, more so than having the LPs that are listening. But I enjoy teaching people, how to get involved. And I just think it's a shame that, it's kind of like a hidden thing until you meet somebody that's in this world.
I agree on that. So we're out of time, but I wanted to ask you one last question. What do you see as a future of the multifamily investing, and how do you see the market evolving over the next few years?
So we definitely have headwinds, right, with higher interest rates. So that is a challenge because people are like, why do the higher interest rates matter? Well, higher interest rates, then your payment on the loan is higher, so it impacts cash flow. That's a headwind, but I don't know. I'm still buying. I'm still a believer that in growth markets, people need a place to live.
That's true.
And so I'm in the Dallas market, and I look at single family homes, residential homes have skyrocketed in price, and then so the price of single family homes went up, and then interest rates doubled. Well, how do you afford a home? So I'm thinking that that's going to force more people to stay in the renter community. And then there's all this talk about, we may have a major recession. We have an inverted yield curve. There's all this talk about having a major recession coming. It hasn't, really shown its head yet. But if it does happen, what happens during a recession? Typically, if there's layoffs and you have a mortgage, you have to sell your house, right? And if you sell your house, you have to live somewhere. So you're most likely, that's going to increase the renter pool. So in addition, typically the Fed will start cutting rates to try to stimulate the economy. So I think we're at a difficult time right now, but I'm still a believer in the future. It may not be positive for 6 months or a year or 2 years, but when I look at 5 years, 10 years down the road, I want to be owning as much as possible.
I agree with you because it's a long-term game. It's a marathon, not a sprint. So whatever you're getting today, it's not we are getting out the next day either. We are kind of good for 5 to 7 years in each deal. And 5 to 7 years is going to be a different trajectory. Market is not going to be the same. We're not going to be in recession 5 years from now. Inflation is going to be that high either. So things going to be different. So you have to keep that in perspective. And that brings us to the end of our podcast. But I wanted to ask you one golden nugget for my audience.
One golden nugget. I would say push past the fear. I mean, everybody is afraid, and especially that first investment property, whether it's a first syndication or buying your first investment property, you got to figure out if it cash flows and the numbers work, you got to push past the fear and do it.
That's true. I agree on that. Everybody should look into investing, some kind of vehicle of investing, because that's the way to go. If you're not investing, you are wasting your wonderful, wonderful resources called time and money both. So you need to turn into that. So this brings us to a rapid fire round. I'm going to ask you 5 questions. You have to answer in 1 word or 1 sentence only. Spontaneous answers. Are you ready?
Okay, let's see. Let's go for it.
I just wanted to scare my guests. That's what it is.
We'll see. Okay. We'll see. All right, here we go.
Okay, let's go. The first question. What is one of the most important things that you have learned in your life, and how did it change your life after learning it?
You got to take risk.
I love that. That's the important thing in life, right? If there's no risk, there's no excitement in your life.
I mean, I'm 53 and lately, I've been listening to people that say, what do people say on their deathbed? And most people, their regrets are things that they didn't try.
That's true. What are you going to lose, right? When you're trying, because you came with nothing in this life and you're going to leave with nothing. And this is the line that we have between B and D. And that's the life is, I would call it E, like enjoyment.
Right.
Whatever resources that we have, we should use it fully and use the optimum skill sets that we have or knowledge, whatever you can call it, and use the best possible use of our life. We're not going to take anything with us. But the thing is, it's just a matter of understanding.
Yeah, okay. What's your maximum potential?
Exactly.
Right?
Exactly. Optimal potential is very important. And every life, I think, on this earth wants to use their optimal potential. But the thing is, our conditioning is a such way that we have so many limitations around us and we never get out of that. I think that's a topic for another time.
Sure.
Uh, can you recommend one good book to my audience?
I love is it something tribe? Tribe of mentors or something like that. It was about three different. So there was health, wealth, and I forget what the success or something. And there were all these interviews with other people. It was Tim Ferriss, and he had the best of his podcasts. And when I was done with it, I told my wife, I said, I'm not meeting the three people tomorrow, because I would read about three people every morning. And then when it was over, I was disappointed. Like I learned from each one of them.
Nice. Good one. In one word, what does life mean to you?
Relationships.
I like that. What is your biggest passion?
Inspiring and teaching others.
I like that. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
Buy real estate and hold it. Don't sell it.
I like that. How can people reach out to you, Darrin?
Best way is join.darinbatchelder.com. That would be the best way.
Thanks for coming to my show, Darrin. I really enjoyed our conversation today.
Vinki, that was a lot of fun. Thank you for having me on.